All right, I want to show y'all something you can do if you get a Bloomberg account, which I think is pretty cool. You get a Bloomberg account. I can't show you because I don't have a Bloomberg machine, but I could, if I had it set up in Bloomberg, I've got the today function, which just says whatever today is. And then I have it do today minus 365. So I have 1 year. I've got the previous year and a half or the previous year ends, so I can get year to date. And then I have the last week. So I pasted the values here, but what I can do is I can look at, you can bring in all kinds of markets, large cap, small cap, growth, value, NASDAQ, Nikkei, anything you can, any markets out there, you can bring in emerging markets, gold, oil, gold, the US dollar. There's all kinds of, you can bring in Bitcoin, all kinds of things. And then I can show, okay, last 7 days, Bitcoin, Ethereum are down a bunch, but they're up a bunch year to date after being down a bunch last year. Oil's up this week, but down year to date. You can see the last 12 months, everything's down. But if you're going in the interviews, it's nice to have what we call just dashboards. So you can quickly see, hey, what's up, what's down last week, year to date, last 12 months. They expect you to know this kind of stuff because they live and breathe it. So they're a little bit shocked when students don't know it because you don't tend to be as much into it. But you can set this up in Bloomberg. You can update it in a nanosecond. Same thing on the sectors. You can bring in all the different sectors. So tech, energy, financials, each one has their own little ticker. And then you can look and see what sectors are up or down. And just knowing the largest one going into an interview, say, wow, you know, energy's been up this last week, but it's not up all that strong year to date or whatever. We know communication services is down because Meta had a bad week. It's the biggest stock in that one, but it's up year to date because why? Because Meta has had a great year. So sometimes you can just look at that and tell. Consumer discretionary is up the most. While energy's up the most this last week. And then obviously last 12 months, energy's up the most dramatic last 12 months. And communication services is down the most. And why is that? Because Meta's down, right? You have the biggest stock nosedives and it causes some issue. You don't have to memorize all of these, but if you quickly, before you go in an interview, you just know what the biggest ones are. It gives you something, you know, just, it's amazing in interview, throwing in something like, wow, the energy's up almost 30% the last 12, just something like that is very impressive because most students don't have something like that on top of their heads. So I call them dashboards. Create a dashboard, and Bloomberg's the perfect place to do it. I've got it set up so that it goes back to 12/30/2020, but you can go back from the S&P, you can go back to the 20s if you want to. 1900, I think it even goes back to. And then you just go on the Bloomberg and say refresh, and it updates everything, and all your charts are automatically updated, and you have everything you need in a nanosecond. It's really, really impressive. So, but not only that, if you do it, then you can also say you did it in an interview. So you can say, yeah, I got this dashboard I'm monitoring Bloomberg, see how markets are doing. That by itself puts you ahead of probably 98% of the people you're competing with. That's pretty good if you're ahead of 98%. And then they may say, oh, you really, well, can you show it to me? And you could email it to them. Say, yeah, here's my dashboard, and it's tied to Bloomberg. That by itself is pretty impressive. So anyway, if anyone wants this spreadsheet, let me know, but better build it yourself. But the nice thing is it gives you all the tickers. You do have to learn all the tickers. But if you go into the Bloomberg machine and just type in Russell 1000 value, it'll tell you what the ticker is, whether that's RAG, RAB, whatever, they'll tell you what those different indices are. If you want to know what the FTSE is or whatever, any market out there, it can tell you. China, any market, it will tell you what the ticker is. All right. So today we're going to finish up stocks. and get started on alternatives, and we might get into the tactical allocation. That's the last part of the exam question we got to get into. So let's finish up. Last week, we did beta, capitalization, and style. So all we have left is US versus non-US or international stocks. Do you remember the difference between global and international? Anybody? Global includes US, international doesn't include US. Okay, so it's international include emerging markets. It does. So you have to, it's possible if you have international doesn't include emerging markets, they're going to say developed markets. So they'll tell you it's developed or not. There are some international stock funds that don't have emerging in them, and you'll just have to know from their perspectives that's what they do. Most of them will have at least a little bit of emerging in their sector, in their portfolio. But there are some they're called international stock funds that don't have emerging markets in them. But those are the kind of questions you're looking for. So we have US stocks. We've already talked about them. That's when you break it between beta, capitalization, and style. So you have blue US large cap value stocks. That would be a category. Then we have developed markets. Those are those larger, more stable developed markets. They look a lot like the US large cap or small cap. There's developed market small caps. But you get diversification from their economies and their currencies. So we talked about with bonds, when you buy non-US bonds, currencies take over. And you're really just investing in currencies. But with stocks, that's not the case. Currencies are very volatile. Stocks are very volatile. When you put stocks and currencies together, they somewhat offset each other. And most people don't hedge out the currencies. If they buy 10% Japanese stocks, they've got 10% in the yen. That's just a combined combination. And let the currencies be somewhat of a diversifier for them. There tends to be a correlation between returns, currencies, and economies. So the US stock market struggles when the US currency is strong, because that means the stuff our companies sell are going to be expensive overseas, right? The US dollar is strong. It's going to make our products more expensive overseas. The Japanese yen's been really, really weak. That makes Toyota's cars and all those cheaper in the US to the extent that they make them in Japan. Just Toyota sell any cars in the United States they don't make in the US and Mexico? Do they actually make cars in Japan to sell in the United States? I just don't know anymore what they're, so, who knows how much of the currencies they may be hedged themselves. But generally, if your economy is weak, your currency will be weak, but then that helps your exporters because then their goods will be cheaper. So you'll see on the exam, I somewhat diffuse that issue because it can get really complicated. I diffuse it and make it really, really obvious. But in real life, it's not. And currencies is the funny thing. Most governments say we want a strong US dollar, and then they do everything they can do to weaken the US dollar, because it helps exporters. But they won't say it. No one ever goes out, we got to weaken the US dollar. No one ever says that, but that's what they actually want to do because it helps their exporters. But what's the downside of a weak US dollar? What does that do to inflation? Increases inflation because imports are more expensive. So currencies are the strange thing. You can see why I hate currencies so much. I was responsible for currencies at UTSA, and if they had known how bad I am at currencies, they would have never given me that, because they're so convoluted, they're so complex. So ask the question: do you want a strong currency or do you want a weak currency? And the answer is yes, you do, absolutely. Both are good, both are bad. So it just depends on the situation. So developed markets, we tend to, when you're buying developed markets, you're buying the market and the currency, and those two risks tend to kind of balance each other. Emerging markets, they tend to be much more volatile than the currency. And a lot of emerging countries, their currencies are somewhat pegged to the dollar. So you get more emerging markets than you do get the dollar impact. So on the exam, you'll see when I'm talking about the dollar, I restrict that just to developed markets. I don't want you commenting on the dollar with the emerging. It does have an impact. I'm not saying it's not important. It's just not as discussed as much. So emerging countries, these are the countries that are fast growing, developing markets, they tend to have high expected return, but with tremendous risk. They do provide a little bit more diversification benefit than others, but not as much as in the past. The entire world right now, when the US sneezes or China sneezes, the whole world tends to catch a cold. So we're kind of, it used to just be the US, now it's US and China. And especially China. China is such a big part of emerging countries right now with their Belt and Roads initiatives. So these countries are becoming more and more entwined. Then there are frontier markets. These are the very, very troubled markets that do have publicly traded stocks, so you can invest in them. But boy, you better know what you're doing. These are dangerous. I've never done frontier markets ever. I've done emerging. Emerging is pretty common, but frontier, I don't know if there are frontier market ETFs. It'd be interesting to see if there were. A lot of emerging and international markets don't have any frontier, because it's a pretty specialized market. And the internet's not working very well today, so I can't show you. I don't know why the internet's frozen, but that would be interesting. It would be a type of asset class that could be up 70% and down 90%. I mean, it just should be a wild ride. And it'd be interesting who the actual managers are, because you'd hope that the people managing it have some experience with those countries. I remember a good friend of mine, Warren, we're still good friends. He went to New York and started a hedge fund, but he ran USA's international fund, fluent in 2 or 3 languages. It's always cool listening to him answer the phone, because he'd be speaking fluently in, say, Japanese, talking to someone overseas. It's the negative side of running an international market is you may have to come in at 3 a.m. because the Japanese market opens a lot earlier than US markets, so they tend to have some strange work hours. But especially frontier markets, why you better have some background, grown up in those countries or something, have some background that you know what's going on there, because they're not easy to understand countries. So MSCI is the famous one. The internet is completely frozen. I don't know why. See if this will work. So MSCI stands for, anybody know? MS, you've heard of it. It's not Merrill Lynch. Morgan Stanley, and what's the CI? Capital Indices. No longer owned by Morgan Stanley. So that's why it's not Morgan Stanley Capital Indices, it's MSCI. So they sold it off. How do you make money doing nothing but indices? Well, if you put the S&P 500 on your stock mutual fund, you have to pay Standard & Poor's money. If you put an MSCI index, the EFA, y'all heard of EFA. If you put EFA on your mutual fund, you have to pay MSCI money. Sounds like a really easy way to make money, doesn't it? You create an index, people start using it, and they just pay you royalties. And all you got to do is keep the index going. You got to find an index people want. Vanguard got tired of paying for the indexes, so they just created their own. And say, hey, ours follow the others pretty closely. So here's developed markets: Australia, Austria, Belgium, Canada. So a lot of Europe, obviously. Denmark. Now, Canada's interesting. I mentioned EFA. EFA is the most well-known international developed market index, but it excludes Canada. So what they have to do sometimes is take EFA plus Canada. And why is Canada excluded? Because it's in North America, but it's not in the US. So Canada is kind of left out a lot. So if you want Canada, you'd have to buy EFA plus a Canada index. But the rest of this would be an EFA, Denmark, Finland, a lot of Europe. Hong Kong's an interesting one, isn't it? And more Europe. Israel is one of the few non-European, non-Asia that's in the EFA. Italy, Japan, it's a major one. Netherlands. So it's dominated by Europe and a few Asian countries. Although Japan's the bulk of the Asia. Singapore, it's not even a country, right? It's a city. So so a lot of Europe in there. And then United States is a developed market, but it's not an international market. So, and then the emerging, a lot of South America, Brazil, Chile, Colombia, and then some old Eastern Europe countries. India's in there, Indonesia, Korea, South Korea, obviously. Although I'm surprised South Korea is not in developed. And then a few Arab countries, Peru. I was just speaking to my Spanish teachers in Peru. I was on a Zoom with her this morning. Her country is going through quite a upheaval. She told me all about it in Spanish. So don't ask me what's going on in Peru because I can't tell you. I know she was really animated about it. I've heard. I mean, I've been reading The Economist on it. Qatar. So a lot of just kind of all over the place. And then you get into frontier. Argentina used to be one of the richest countries in the world. And if you want a country that knows how to really mess things up, Argentina is the perfect example of that. I don't know if any country's gone bankrupt more than Argentina. Well, I don't know if Venezuela is even on the list because I don't know if they have a public. You have to have a stock market to be in here because you have to be able to trade stocks. Huh? Well, yeah, with the inflation, I don't know in US dollars. You take a country like Burkina Faso, you must say, how do they have a stock market, right? The whole country's just in civil war, it's a disaster, but that's a frontier market. Would you invest in Burkina Faso right now? Have you been reading the news? I mean, it's kind of sad, isn't it? That's a country that should be really wealthy, but because of corruption and all kinds of things going on. So there's some countries on here that just want to make you cry because their people should be so much wealthier, but just so many things going wrong. But yeah, that's important. Are these the type of countries you want to invest in? Well, the exciting thing is they all have serious problems, but they don't need much of good news for them to just take off. So you almost want to find one that's a disaster like Venezuela and hope maybe they'll return to democracy and open to the markets, although I don't think you can invest in them now. I don't know why Iceland's in here. I don't know enough about Iceland, why they wouldn't be developed. Yeah, it's just isn't that interesting? Russia's a frontier market. Russia might be a standalone market. They say standalone, which means they don't put them in any category. So yeah, it's if you want to make your whole career, that's what you can do. You can learn one country. If you got some language skills, you've lived somewhere in one of those countries, you could certainly make that your entire career. We need people who know nothing but a particular country, know it backwards and forwards. Someone will hire you just for that. There may not be trillions of dollars invested there, but there's billions of dollars, and they need someone that knows that. And so, yeah, that could be really valuable. So I always tell students, if you have language skills and you've lived somewhere, there's someone that needs that knowledge somewhere in the world. So yeah, take advantage of it. I'm not advocating the frontier markets for your portfolios. You're on your own on that. And you notice some of those countries have like 3 stocks. And that's about it. It may be a concrete producing company or something. There may not be much there to invest. And that's what a lot of people do with emerging and especially frontier is they just invest in the 1 or 2 biggest companies in that particular country. So instead of trying to buy the entire market, they just buy the biggest players because that's where the most liquidity is. So you get a lot more diversification in the frontier markets, although a lot of them really would mess up badly if the US went into recession. But they tend to be on their own little schedule sometimes. It depends on what's going on, civil wars and election and those kind of things. Here's how S&P breaks them up. So Frontier, you have to have at least 2 of these things, which, you look at these things, market capitalization greater than 2.5 billion. What is Apple right now? 2.5 trillion. We have one stock that's 1,000 times bigger than they want the entire stock market to be. So they're not asking for much, are they? 2.5 billion is a really small company in the United States. Turnover $1 billion. I don't know what the US turnover is, but it's probably, 1,000 times that or more. And then exchange development ratio. This is one reason China has struggled to move from emerging to developed. So your development ratio, that's what is your stock market as percentage of your economy? So, it's got to be at least 5%. China probably matches that one, but you got to get much higher than that to be a developed market. And then developed market capitalization more than 15 billion, still really, really small. Settlement, this may be changing. When I was at USA, we had T+0. So, you're probably used to T+3. That's the way that's why you hear it. So you do the trade today and the money doesn't actually change hands for 3 days. But I did trades that were T+0. So we'd actually fund the trade on the same day, but you have to be at least T+3. Sovereign debt has to be AA or better. Obviously US is, I guess AA plus and AAA. No hyperinflation. So any countries can you think of that have hyperinflation right now? There's a few of them in these, aren't there? Turkey is, a good example of Turkey. Do you think Erdogan will lose this election, and what will you do if he loses? Is Turkey a place you would invest in right now? Huge disaster, really, really sad. In fact, you're still finding people, aren't they? It's kind of amazing. A week later, finding people. Pretty disastrous. What would happen if Erdogan lost the election but didn't leave office? What would happen? That's kind of interesting. Why is that interesting to an investor? Well, it could mean there could be a major, major blow up in Turkey, which might be the right one you want to invest in it. Do you want to invest at the top or at the bottom? So you look at something going on in Turkey, you say, wow, this might be, do I step in? What do I do? What would happen if there's election in Turkey and Erdogan loses and he leaves office without a conflict? What would Turkey's stock market do then? I would guess it would probably go up quite a bit, but do you take those type of risks? So hyperinflation, ownership restrictions, another issue China has. It's sometimes difficult for investors outside of the country to actually invest in that country, and that can cause restriction. And you have to have a foreign currency that trades freely. And then per capita GDP 15,000. Boy, I can't remember. China GDP per cap. They're 12,000. They're not quite there. The US per capita 70,000. So China's 12,000. People worry that China's economy is going to be bigger than ours, but they also got 3 times more people. It's really the GDP per person, 70,000. That's a pretty healthy number, isn't it? I can't. Now Emirates is 44,000. Well, I'm trying to think of the wealthiest countries. Luxembourg. I don't know how to spell Luxembourg. Luxembourg's 133,000. That might be a nice place to move. Y'all even know where Luxembourg is? Next to Switzerland somewhere. I have a friend from Switzerland. I was like, have you ever been to Luxembourg? Yeah, it takes like 5 minutes to drive across it. There's got to be a higher one than that one, I think, but I can't remember. I don't remember like Qatar. They're only 66,000. So there's probably someone higher than Luxembourg. And then you have countries like Chad, $685. That's a really low. Who's lower than Chad? I can't think of. Sudan obviously is struggling right now, but they're even better. Can't remember my there's probably a Uganda, maybe. What is the poorest country in the world? No?
Pretty poor.
Oh, really? Oh, okay. I don't know how to spell it. Mozambique. 491, that's pretty low. Some people have been predicting Africa is going to be the continent of the century because they have a young workforce, a lot of natural resources, a lot of precious earth. But it's the governance, right? You got to get the governance down, you got to get the systems and all that, infrastructure, roads, but there could be some things going on. There's some countries doing well. Bahrain, I don't know how to spell it, or Botswana is one. If I could spell it. Botswana. So 6,800. So there are countries that are doing much better than others. I don't know what South Africa is. I haven't looked at South Africa in a while. 7,000. So when you think about investing, it's the key is the change. That's what you're always thinking about. Which of these countries have the best opportunity to really improve? So you're not so worried about the level, you're worried about the change. So it's new politicians walk in, some new law gets passed, those type of things. You know, I get frustrated in Costa Rica because their government does things I think makes their people much poorer. It's so hard to do any business at all in Costa Rica. Everything you do is just a major pain. It's a country that should be much wealthier than it is, and just government policies. But those kind of things can change very. Just like I said in Peru, it's going Peru's been the darling of South America. Now they're going through a major crisis. Things can change so quickly. Brazil has a new president, right? So who knows? So when you're thinking about where you're going to invest around the world, you're not just looking for good countries, you're actually looking for countries that are about to improve a bunch. And that takes such deep research. You got to know how many presidents of African countries do you know off the top of your head? Maybe South Africa and any others. It's like, I can't keep track. So it's tough. But there's a whole world there that you can really become a detailed investor. The last several years, the US has been the place to be, partly because US economy has done well, also because the US dollar has done so well. So the US economy, does that mean you should avoid these other countries, or does that mean this is the time you should get into those other countries? So, you saw COVID really hurt the US, but we came back. The rest of the world is still kind of struggling there and has essentially not earned anything the last several years. So the US has been the place to be. And the key is, I think the single most important thing is productivity. We already talked about that. Which countries have the most opportunity for improving productivity? And productivity is what? It's young people. We talked about that before, didn't we? Who's more productive, a 60-year-old, a 50-year-old, or a 20-year-old? Well, the 50-year-old is more productive. But that's not growth. Growth is change in productivity. Whose change in productivity is higher? The 50-year-old or the 20-year-old? It's going to be the 20-year-old. So that's why people are so excited about Africa. You have young workforce. It's got to get good training and good jobs. So you have young workforce. Their improvement is going to be much faster than a bunch of 50-year-olds. So you're looking for countries that are, and there's not many young countries left. Right? The world is dying. Are y'all going to have 2.5 2 kids. That's the replacement rate, right? Well, each of y'all average 2.2 kids, do you think? What is the birth rate? $1.64. We need 2.2. We got 1.64. What's Japan? $1.3. The developed worlds are just we're all dying. We're going out of we're just disappearing. And then you look at a I don't know how to spell it, Ethiopia. I just saw it right there. Ethiopia 4.2. That's where the growth is. That's where young people are. So we have 2 choices. We go invest in those countries, or they all immigrate to the United States. Either one is a good answer, but you got to figure out which of those is going to happen. They're going to come to the U.S. if there are more opportunities here, but how can we get there to be more opportunities in Ethiopia? How do you change the world? You know, so who knows?
I've heard that a lot of the reason some of these countries don't do very well is because the US cycles off all the trip.
There's certainly debate about China and the United States and what they're doing to these countries. Yeah, China especially has gotten a lot of news about saddling these countries with a lot of debt, and then they're not getting the benefit from it. Yeah, it's.
I was more thinking like immigration is great for the US. But for these
Oh, we
countries
take the
that
best.
I guess they're sending money back home, but like a lot of them, they're just kind of losing people, right?
Yeah, you lose. Well, it's hard to go from Ethiopia to the United States. So who's going to be able to do that? It's going to be your most able-bodied, smartest, most energetic people, because it's, you know, it's not the easiest thing in the world to do. So yeah, they're losing their best people. I had students from what country were they in? Gosh, I had one student from Kenya, and he was almost in tears. Like, I love the United States. I want to stay here, but I also love my homeland. I want to go back and want to fix the whole thing. But at the same time, we don't think it's fixable because the government's such a, you know, hope. He's got this tug of war going on that he'd rather go back there because that's his, you know, everybody prefers to be in their homeland where he grew up, but there's a hopelessness that, you know, so who knows? But the key is productivity, and productivity is young workers. It's good capital markets. It's private ownership of property that's protected by the government. It's all those things where people are willing to invest, take risk. You know, you're not going to take a risk if the government's going to take it away from you a year later. So you got to have all those kind of rules in place. So you as an investor, you're trying to figure out where in the world is that the most exciting? Where's the world the most productive? Good education system, all those kind of things. And you know, your guess is as good as mine on that. Now, not everybody uses this approach of the U.S. and you have large, small growth and value, and then the rest of the world is just developed, emerging, and frontiers. So there are some people that are global investors. They say, forget about U.S. large and small, just do global large cap, global small cap. So forget about location, just look at capitalization. I don't think there's that many investors like that, but there are a few. Some people, and this is kind of gaining ground, is saying there's some sectors that are global and some sectors that are local. So when you have a global sector like energy, then view it as a global market. Don't think about US energy and UK energy and Brazilian energy. Just say global energy. Make your investment. You're going to do BP or Exxon. And then more local, like consumer services, like restaurants, that's where your country specific. So that can make some sense. I mean, is there really a big difference between Exxon and British Petroleum? Aren't they essentially competitors in the same market? They're doing the same type of thing. Yeah, there's some currency issues there, but essentially you don't want to look at them all that radically differently. So what you're trying to do, again, is parsimonious. How can you split up the world in a way that you're going to explain risk the best and be most efficient? So maybe on energy, you just do global energy. On restaurants, you have US, Europe, however you want to do it, but you think in those type of terms. There are a lot of really good resources out there. Street Smarts, I like Jim Rogers. One thing I like about him is that he's old and rich, which means he speaks his mind, so you get exactly what he thinks. He's not worried about offending anyone, so he gives you the lay down. His view is Asia's the place to be. So he's an Asian tiger person. So much so that he moved his whole family to China. And then he didn't like China because they had some air quality issues. So he moved to Singapore. But both of his daughters are fluent in Mandarin. So, I mean, he put his money there. He says Asia's the place to be. So that's where he went. But he has a really good book out, Street Smarts. It's a few years old. Adventures on the Road and in the Markets. And he talks about where to invest in the world and how he makes those decisions. So pretty interesting. I love this book. It's a little lengthy, but Why Nations Fell, The Origins of Power, Prosperity, and Poverty. If you're a global investor, you want to understand why do some nations do really well and why do some nations not. Argentina should be one of the wealthiest nations in the world. Why did it fall apart? And they talk about that in the book. Why did the US do well? Why did certain countries do well? And why do other countries don't do well? Is it because they're on the coast, so they have access to the oceans? Is it because they have natural resources? There's actually a debate in his book that natural resources might actually make countries poor because of the way natural resources tend to get exploited. Those are kind of debates that they have in the book, and they have a very clear theory. So it's something that's actionable. It's not like it's 87 points. They make a few points about what nations will do well, what nations will do poorly. So it's a really good book. If you don't want to read a book that's long, you can do this class in the great courses, which is essentially a summary of this book. A student of mine sent me this. He said, wow, I really like this class, is really good. And as I was listening to it, I go, wow, that sounds exactly what I just read. And then he references this book that I was just reading, so he summarizes it. The reason this book is so long is they very quickly have their theory, and then they give hundreds of examples, which I kind of like. And what they're trying to do is prove that they've thought of every single possible combination or whatever scenario, that their theory works all over the world, every country, every scenario. So they just want to prove themselves. So I didn't find it getting boring. I thought it was kind of interesting. This guy Sharma from Morgan Stanley, he has, let's see if I can find it. He had a podcast from Barry Ritholtz. It's a few years old, but I found it really interesting. He talks about the 4 Ds. The 4 Ds are depopulation, which we just talked about, that people aren't having babies anymore, so the world's shrinking. Deglobalization, there's been a lot of anti-globalization going on. And he asked which countries will benefit from that. He says it's going to be the US, it's going to be the biggest beneficiary, and a country like Germany that's so dependent on globalization is going to be the big loser, but you can read his. Deleveraging, governments have so much debt, they're going to have to get rid of it. What's that going to do to the world? And then de-democratization. It amazes me the surveys they do around the world of how anti-democracy the world is becoming. People are losing faith because we're electing people that aren't doing a very good job, in my opinion. And people are just like losing. You can ask them, what do you want instead? And there's some people say, just give me a military dictator. And they're thinking about the good old years that weren't all that good, but that's what they're remembering, stability and all that. But, so what does it mean for a world that's moving away from democracy, having to pay down massive amounts of government debt, going away from globalization, and populations are shrinking? You can read his. It sounds kind of negative, but it also gives you ideas of where you want to invest in the world. That's why he says US is do better than Germany, because of his views. So it gives you some insights. Smart guy. He wrote a book. I read his book. I can't remember what was in there, so it didn't stick with me. And then you also want countries. One of the things that's important for productivity is regulation. How does the government actually function? Is it easy to do business in that country, or is it difficult to do business? And there's actually an index, although I think the World Bank has been pulling back on this index. I don't have it here. I don't think I have it. I brought it in. Yeah, I think they've stopped. They may have stopped publishing it. Putin saw that ratio and he figured out how to get Russia higher on the list without doing anything, just with smoke and mirrors. And I think they're kind of like, there's too much gaming going on. Because how do you measure ease of doing business? But you can look it up, World Bank Ease of Doing Business Index. They look at things like property rights, bankruptcy laws. It's very, very important that a firm can go insolvent and it doesn't cause major havoc. That's one of the advantages in the United States. You can start a business, go under, start another business, go under. You just keep trying until you finally figure out how to make Microsoft. Some countries, that's not the case. Some countries, they won't let you go out of business. You're just sitting there as a dead company. It's just horrible. It is, you know, my dealings with Costa Rica, I really see it. I tell this story. My friends from Costa Rica, I needed to get them a USAA bank account so I could get money to them faster. It was like $4.55. We walk into the USAA, it wasn't even the bank. So they didn't have any bankers there. So they set us up on a computer to Zoom. We left there at 5 o'clock with the checking account, some checks, passcode, 5 minutes. We had it all set up. And Alex said it was, you remember Alex said, he goes, yeah, that would have taken like 6 months in Costa Rica. He would have gone to the bank, done paperwork, go back. And 6 months later, you might have an account if you're lucky. We did it in 5 minutes. Does that give us an advantage over Costa Rica? Absolutely. Gives you a huge advantage. How long does it take you to approve a construction project and then get it started building and actually build it? In some countries, it can take forever. Some places, it's a piece of cake. Even in the United States, state versus state, it can be a big difference. So you as an investor, this is what you're looking for. And you're looking for this, what countries are good at this, and in what countries are changing this. What countries are actually changing their politics, so they're actually addressing some of these issues. Here's the PISA scores. So talk about education, which is a big issue for me. US continues, well, this is old. I should see if I could get better scores. US continues to do badly in math, has been moving up on reading. I don't know how we do well in science because my public school science was horrendous. Did y'all learn anything in science in public schools? I thought mine was absolutely terrible. The worst science instructors. But anyway, reading, I guess we're good at reading. We're bad at math. Who's in the top in all these? A lot of Asian countries, a lot of Scandinavian countries. There's some great books on why does a country, is it Finland or Sweden, a country that doesn't have homework? The kids go out and play in recess and they score really high on these things. Why is it? What is it about those countries? There's books been written. Singapore is high on the lists, but the debate with Singapore, I read a book on that their kids come out of high school so burned out that college is just this party time because they're just so burned out from 12 years of doing nothing but tutors and studying. Even China has passed laws to make it illegal to use tutors because their poor kids were going to school early in the morning and going home to tutors all night. Does that sound like fun? Could a US student do that? So it's not so much that they score well on here. It's also, you know, you got college after this, and then how people actually work in the workforce. So there's a lot of debate on this. This is a big interest to me. I just think education needs to be completely disrupted in the US, especially, but probably around the entire world. But interesting countries up here in these different categories, but Singapore and Hong Kong, Japan, you know, you see countries that just dominate these categories year after year after year. In US, usually just in the middle of the pack, even though we spend a whole lot more in education than these other countries do. And it's amazing to me in DC public schools, they spend $31,000 per child in their public schools. What could you do with $31,000 per kid? So people started talking about micro schools. Have you ever heard of micro schools? So take 10 poor families in Washington, D.C., and they get together and they've got $300,000. Do you think the 10 of them could find a good school teacher and have their own school and have it on their own schedule based on their work schedule? Do you think they'd be better off than the public school with $300,000? They could hire a teacher for what, 160, and they'd have 140 left over for all kinds. I mean, they could have their vacation schedule when they want it, not the whole summer. I mean, it's amazing. So yeah, there's people talking some pretty radical things out there, mainly because they're spending so much money, but that's a whole topic. So that's stocks. A lot you can do with stocks. You could have a whole career on stocks, and you can certainly specialize in countries or industries. Any comments on stocks? Now, don't be a typical finance student and you thinking, I got to be a stock analyst, got to be a stock portfolio manager. Don't forget bonds. Bonds are just as exciting. They pay just as well. And there's more specialization in bonds than there are in stocks. Stocks and bonds have the similar things of industry and global issues. But with bonds, you add in the currencies, you also add in structured debt, you add in sovereigns, you add in municipals, you add in a lot of asset classes that don't exist on the stock side. So you can specialize more. So not that you're going to pick your career is probably going to pick you. You're just going to apply and then you pick the job that scares you the most. So if that's stocks, if that's bonds, you just pick the one that scares you. But don't feel like you're kind of sacrificing, I got a job on the bond side and I want to be on the equity side. No, you'll get just as much money and you'll find it just as interesting. All right, let's talk alternatives. What are alternatives? So alternatives are everything else. And the key here are two things. Whenever you hear alternatives, they'll always bring up the concept of diversification. This is something that's not highly correlated with everything else. And then for real assets, you'll hear the issue of inflation. Real assets tend to do well with inflation, though gold didn't do all that well this last year. So when we talk about alternatives, they're alternatives because they help you with diversification. They give some uniqueness to your portfolio. And with real assets, they can really help you with inflation. So we're going to break it up between real assets, and then we could go all over the place. There's so much we can do. So things like infrastructure, venture capital. We'll talk about venture capital, but there's some strange new investment types out there. There's social impact bonds that might be on the bond category or might be on alternatives. So there's just a whole list of them. But we're just going to break between real assets and venture capital. We're just going to have those two categories just to keep it simple. On real assets, we're going to break it into real estate, timber, commodities, and then kind of specialized. All right, so those are the categories. So a real asset, that's an asset you can actually touch, you can actually go look at. Kind of exciting thing of being real estate is, you have something you can actually go observe and look at. Real estate companies, you go to their websites, you see these beautiful pictures of buildings. That's just the way, it's kind of cool. You got these buildings. So real estate, mainly with real estate, we're talking commercial real estate. I used to say from an investor, commercial real estate is really your only choice, but BlackRock and a few other companies have changed that. There's a lot of big investors that are buying residential real estate now. So that part of the world has really changed. But we're mainly talking commercial real estate. So what expected return does real estate have? And we really don't know. The reason we don't know is that real estate doesn't trade every day like stocks and bonds do. It's very illiquid. And so we have to rely heavily on appraisals. So you may have 50 buildings and one sells. So now you got one piece of information, but that building's so unique versus the other 49, it's just kind of giving you a hint of what the markets are like. I remember on my mom's house when I sold it, I went out and got an appraisal They say, yeah, somewhere between 470 and 600. It's like, okay, thank you very much. It's really, really helpful. The Zillow value was 540, kind of in between. 540 is what I got. They said you could probably get 600 if you fix the roof. Yeah, it's all over the place. And that's a house. That should be pretty easy to value because there are a lot of houses being sold. But here we're talking commercial real estate, big hotels, big office buildings, those kind of things. So it's hard to know truly what the return and even more what the risk and correlation are. Because we don't have reliable numbers. First of all, the indices on real estate tend to be quarterly, not monthly. To get a good correlation, you really need monthly data. But if you only have 4 pieces of returns in a year, it makes it really hard to do correlation. And then those correlations are completely unreliable. Because if you're relying on appraisals, appraisers are much less volatile than markets. They tend to stay pretty static. They'll move around a little bit, but they don't move much. And so you don't really know the true expected return and risk of real estate. It's a very, very illiquid asset. It's not, if we're talking about, you know, multi tens of millions, hundreds of millions of dollars building, you're not going to sell that in a week or in a month or in 6 months. Have y'all seen the new condos going up in New York City? They're kind of freaky, aren't they?
For big New York City.
Businesses are I don't know why we can't get anything to work here. Yeah, I'm sure y'all have seen these things. These things are like, they look like they're about 10 feet by 10 feet. Yep, you haven't seen these? They're 100 stories high, and they're like, it looks like you can wrap your arms around them. They're so thin. I would never live in something like that. I don't like heights, and yeah, buildings swaying doesn't encourage me. So New York has a problem where office space vacancy rates are really high because people are working from home, and so they're converting a lot of this office space into living areas. There was an Economist article that said downtown New York, down in the financial district, used to have like 700 people living there, and now there's 700,000, and it's like people are now living in these buildings that used to be office buildings. So very illiquid, very expensive. These are billion-dollar buildings. Just amazing buildings. They really stick out. I think it's strange. I'm not used to these kind of toothpick thin buildings that are really, really tall. They're really strange. A lot of them are near Central Park. So you got these great views of the river and the park. But I don't know who wants to be on the 100th floor of something. I would probably buy a parachute if I was on a building like that. Just, you know, some way if there was a fire, a building like that would just go up really fast. But anyway, so it's a very different type of asset class, very unique. Each building's its own thing. So we break it up by geography and property type. Geography, obviously there's the US and international. And then with the US, we break it up, you know, Northeast, Northwest, South, and Midwest, that kind of thing. So geography is important. Probably more important is property type: hotel, office, retail, industrial, apartment, malls. Office and malls, obviously, right now are really struggling, probably even retail somewhat. Industrial is doing extremely well because of Amazon and Intel and those type of firms that are building these massive, massive industrial parks. So the industrial side is doing really, really well. I don't know how apartments are doing. Hotel has, you know, obviously COVID was a major hit to that industry. So property type, and you would be real careful which property type you wanted to be in. I don't know if I can get Nick Reef to work here. We'll see. See if I can find some images. I'm sure y'all know what y'all see what I'm talking about? Would you want to live in that? Oh yeah, I mean, there's some condos out there, they're the entire floor. So they have blast all the way around, but I still wouldn't want to live there. I wouldn't even want to visit there. I hate heights so much. It's like, yeah, I'll just send me some pictures. But these are getting really popular for some reason. I don't know the financials behind making the building so thin. Obviously, you don't use up much space. Oh, some of these are 20 million, 30 million. I don't know. Boy, they're pretty ridiculous. So NACREEF has a good website. They used to provide return data. Now I think you have to pay for it. But they used to provide quarterly return data that you can actually bring in. We used to use it for our modeling, but it is quarterly, so it's hard to use it against anything else. But there's their website. Yeah, they're okay. So everybody's changing their websites because they want to make money. So NACREEF's a good site to use. This is commercial equity real estate, which means to buy this, you have to buy the real estate. You're not going to buy this on the stock market. This is not publicly traded stuff. This is individual properties. A firm like Prudential will have a big real estate arm where you can actually invest as a private investor. They have a big pool. So maybe they have like a $500 million pool and you can invest in that, but it's still, it's not liquid. It's not public. And, you know, you're an individual investor getting into a fund. Most real estate is like that. Most real estate is privately owned, or it's in an investment pool that's really hard to get into. I mean, they may say you can invest in our pool. You have to invest at least 50 million. So they're not going to talk to small investors in there. And so someone said, well, what if we can take real estate and make it liquid? Let's create something called a real estate investment trust. That sounds pretty cool. And that's a REIT, that's a stock. So we're going to have real estate that's going to trade just like a stock. We've solved the whole problem. Now we got daily information. We can get returns. We can get risk. Have y'all heard of a REIT? Or REOC, a real estate operating company? These are companies that own real estate, but they trade as a stock. They're a small smidgen of the real estate market. Small smidgen of the real estate market. They're like 3% of the S&P 500. And yet real estate's larger than the S&P 500. So it's a small smidgen. And that's what a lot of people think is now we can buy real estate finally. The problem is REITs don't look like real estate. They look like small company stocks. They look anything. They don't have the characteristics of real estate. They have very high risk. They have the returns of small cap stocks. So essentially, they're small cap stocks. REIT has they have a good website, REIT.com. Their website finally came up. You have a bunch of pretty buildings always. They do have data that, but last time I tried it, it costs some money. So REIT.com is pushing REITs. They're not pushing real estate. They're probably pushing REITs. So they're a little bit different group, and nothing's working today. I don't know what this default thing on the end is. So you could probably take that off. So are REITs stocks or are they real estate? I believe they're stocks. They're not real estate. I inherited a mutual fund. Unfortunately, before I inherited, they fixed it, but it was a fund that was, just believe it or not, a ridiculous fund. It was 25% stocks, 25% bonds, 25% gold, which is crazy, and 25% REITs. What a ridiculous mutual fund. That thing just about blew up. When gold just did so horribly for so long, you have 25% in gold. It was terrible. They wanted the 25% in REITs to be real estate. Instead, what they had 25% in a very small cap sector of the small cap market. So that blew up. Terrible fund. By the time I inherited it, it was 70% stocks and 30% bonds. They got rid of the REITs because REITs, just real estate is a good diversifier, no question. UTSA had a large real estate portfolio. It did provide great stability to their portfolio, but it was equity real estate. It wasn't a REIT. So you're not going to buy REITs and it's going to feel like you're investing in real estate. So residential real estate I've left out. I don't know if there are residential real estate ETFs like REITs or whatever. I'm sure with all the purchase that's going on, that's starting to move markets. So you have firms like BlackRock buying a bunch of houses and then reselling them. It's definitely having a huge impact on markets. So now we had a meeting with NAREIT, and they came and they wanted to prove to us that REITs are no longer small caps. They're starting to look like stocks, and they brought some really convincing data. I think NAREIT hired Ibbotson and Association, so I think it was actually Ibbotson's that came in, and sure enough, their data was right. REITs had definitely changed. They look more like real estate. I said, wow, that's really interesting. I hadn't noticed that. So we went out and updated the numbers, and they were showing us a very unique, like 6-month period of time after their data in the REITs went back to their normal small cap selves. So there was a short period where REITs looked different, and now they're back to where they were. So, so that's real estate. Real estate's, if you do residential real estate, you're going to buy houses. It's kind of strange investing because you're going to be pretty concentrated in one city, in one location. You know, unless you're buying 100 houses around the United States, it's a pretty concentrated portfolio. So I know people that do that, buy houses, fix them up, sell them, switch them around, all that. That was real popular a few years ago. That's a very different type of investing. And the biggest problem there is diversification. You just don't have much diversification. I've known people whose entire net worth was destroyed because they bought a $500,000 house. They're going to sell for $800,000 and they sold it for $300,000 because the market crashed. So it can be really, really dangerous. So it's really hard to diversify. But I do know people, this is their career. This is what they're doing. If you know what you're doing, you can manage that, but you got to be aware, you know, if markets crash, you could have some really lean years.
Why do REITs, what do you think the disconnect between REITs and other real estate is? Where is there?
When you trade every day, it really changes the nature of an asset class. You get that daily information. It just makes things more volatile. Markets overreact, underreact, those kind of things. When you own the actual real estate, you can ignore most of that. That's why, you know, you look at a Zuckerberg, he doesn't really want to take Facebook public because of that reason. He doesn't have all that daily noise that he has to worry with, but he makes a lot more money if it's public. So that's kind of the thing is if you're a private firm, and you remember when Dell Computer went private, it was for that exact argument. I want to get out of the market so I don't have to answer the stockholders every single day. So yeah, it does. Now, is it fooling you? Is real estate really that volatile? Well, we just don't know because it doesn't trade every day. Or is it the nature of markets to make something much more volatile than it really is? We really don't know the answer to that. All right, one of my favorite asset classes is timber. Timber is both a real asset and a commodity. It's both. I mean, it's both a real estate and a commodity. It's both. So it's in two categories. So remember, we have real estate, timber, and commodities. Timber is both real estate and a commodity. And it is a very localized market. It's very hard to ship trees all around the world because they're very, very heavy. And so it tends to be very, very localized markets. So that provides you some really good diversification. So they tend to be driven more by local issues than global ones. So good group here. I don't know if their website still works. I haven't tried it, so I won't try it. But there are some good websites out there. If you go to the timber website, I'll assure you the first picture that comes up is going to be a bunch of beautiful green trees. They're not going to show you a bunch of cut down trees. So they're very sensitive about their ecological impact. They argue that they're good for the ecology because they plant a lot of trees, and that's true. They do have a lot of new forests that they plant. They tend to be really good for helping control fire risk and those kind of things, but they do chop down a bunch of trees. But the wonderful thing about timber is that it's both a commodity and real estate. If the real estate market's doing great, you can sell some of your real estate. If the real estate market's not good and the timber market's not good, then you can just wait. And what happens to the tree while you're waiting? it's bigger. It's one of the few commodities that are like that. Most, oil, if you don't like oil prices, you don't end up with more oil while you're waiting. It'd be nice if that would happen, right? Well, we'll just kind of expand, but it doesn't happen like that. Cows, we do a lot of loans to people growing cows. That's true if you wait around, but there comes a limit when the cow's about as big as it's going to get. You're ready to sell it. If you don't like the prices, you're kind of worried they're going to get sick or die or whatever. So, you have some urgency there. Trees don't die as quickly as cows. So they do have that huge advantage. And they have multiple uses as well. There's pulp, there's construction, there's hardwood, softwood. You can also lease out your land for hunting rights and those kind of things. There's a lot that you can do here. If you love the outdoors, don't forget this career. So you got an undergraduate in finance, you go to Texas A&M and get a forestry degree. You'll be rich and set for the rest of your life, and you'll probably spend most of your days outside in blue jeans and a t-shirt if that appeals to you. You want to make 6 digits and be outside all the time, that would be a wonderful career. Now the problem is that would be your only career choice. Would be much else you could do. I don't think you want to be a park ranger because I don't think park rangers pay all that much. But to be a timber person, we met with a guy from this particular company, and he had a forestry degree. And my whole staff was so jealous of this guy because he's like, yeah, I don't usually wear a suit. I'm usually in blue jeans outside, but so great career. I don't know what a forest degree teaches you, forester. I don't know anything about all of that. I don't know how difficult that degree would be. I don't know if A&M even has one. I just assume they do. You can Google best forestry degrees out there, and it would be another wonderful thing about finance is finance pays a whole lot for specialization, and there's one area you could specialize, and you'd be set for life. This is a huge industry. It's not going away. We're still going to be buying and building stuff with trees, and we still have, I guess we don't have as much paper as we used to, but we're still going to have all this stuff. Any questions on timber?
Let's say and I have a client that is that probably a way to
Well, you have to be a pretty large investor. There are some timber ETFs, but again, they're going to look more like stocks than they're going to look like timber. So an ETF is a stock that trades every day. So you tend to, when you invest in timber, it's these large pools. So I've got a $500 million timber fund. You want to invest in it. You bring in your 50 million. So it's got to be a large investor. And your biggest argument is going to be timber is just a very unique asset class. It can do well when everything else is not doing well. Now, obviously, people say, well, timber, and it would have blown up in 2008 because of the housing market. But it's not as obvious as you might think. It did badly, but it didn't do as badly as people would have thought. So it is a fairly unique asset class. A lot of big pension plans and large institutional investors will allocate 5 to 10% to timber, and those investors are always going to be there. So yeah, there's definitely an interest in this asset class, and it's done well over time. It's definitely has proven itself over time. I don't know if we'd ever stop using trees. I guess it's possible, but I think it's going to be around for a while. Imagine we'll just stop any kind of wood construction. Right. Anything else, Don?
In this timber, like, you have a really active rule. When would you
Well, if you go to GMO.com site, they have what they call the 7-year forecast. In the last few years, timber has been their highest. I don't know what it is today, but the last few years, timber has been one of their highest expected return. So there are people out there. So GMO for years was tactical over allocate timber. It's the place to be. You can certainly go look at timber prices and see where they are versus their history versus other things. It's hard to say while China's economy is coming out of lockdowns, there's a shortage of housing in UK and Europe. And that's great, but we're not going to ship US trees to China. They're going to be buying their trees from Asia, and Europe's going to be buying this. They got plenty of trees in Europe. So you really have to, if you're going to look at US timber, you're going to have to look at US construction. Or you buy a timber company that has lands overseas. So, yeah.
I guess the bigger market would be like in Oregon or Washington State.
Oh, Texas is a huge timber producer. Oh, yeah. East Texas, have you been to East Texas?
Well,
There's East Texas is it's a huge market. Yeah, it's one of the biggest markets. We forget about it, but yeah, it's there. When that hurricane came through, I can't remember if it was Ida or whatever. There was a hurricane that destroyed a lot of Texas trees. It was quite a big impact on the.
a lot of low rates and forests too, so yeah. It's for-
Yeah, Texas is a big timber state.
Something like you know what I'm talking
Related to timber or is it?
Oh, no, just like kind of sit in the same vein where it's just real estate dedicated to storage.
Yeah, I don't know on that one. There are some interesting things with trees, like in Costa Rica, you can own a plot of land with trees and they'll pay you just for consuming carbon. So you get an environmental, but it's not enough to really make any money. Collecting water like that, I guess if you supplied it. Yeah, I don't know the water world. Certainly, desalination plants are becoming more popular, but I don't know if you could collect that much. I'm not familiar with that. Water is obviously a big issue right now. But these are all specialized areas. So, this timber is not my thing. I've talked to a couple of timber guys and it's really interesting and it's a really fascinating field, but I'm not an expert on timber. But you could be, and if you are an expert, you're set for life. And that's the wonderful thing about finance. Once you become that expert, there's not many people out there with that knowledge. You just, if there's something like that, Thomas, you could certainly become an expert and make that your whole career. All right, anything else on timber? Yeah, I love timber. And Doug? Well, if you got enough land, yeah. Where we are in Costa Rica and Bertha and Devin saw it, there's a guy went in and bought a bunch of land and he started growing pine trees. It's so bizarre. You're in this tropical forest and then suddenly you're in East Texas. And they've been there for, since I've been going, they first started, this last year is the first time I noticed them with trucks taking trees out. So they're now far enough in, they actually are harvesting trees. And they discovered, you would think the Costa Rican government would be a little concerned that they're bringing in this non-native tree and not just planting it, but putting hectares of it in, but they're doing it. And those trees grow fast in Costa Rica because they get a lot of water. So yeah, you could definitely buy land. And if you saw in Costa Rica how cheap the land is there, yeah, if you want to go do that, that's why he did it. The land is really, really cheap. I forget how much it is per hectare, but it's like when you hear it, you're like, did you leave a zero off of that? So it's really, really cheap. So yeah, you could. Well, timber is just trees, but there's certain things, vertical farming is certainly becoming an issue, but one of my classes did a cost benefit of vertical farming and it doesn't look like it makes much sense financially yet. But certainly farming. I don't know anything about farming. I don't know how much there is investing in farming from an institutional investor.
And yesterday we had a training in my actual working, trying to train all the personnel with all these entities that are now getting legal money, let's say, it's not illegal anymore. They're working with all their relatives, so that we have to participate. So then besides money laundering and whatever, they're trying to train up to how to deal with it.
Yeah.
But I'm thinking of this investment companies that in the future have developed more, maybe they can.
I've never heard farming as an asset class. I don't know why it wouldn't be, but I've never heard. farming as an asset class, but it's certainly,
Not farming,
huh?
is agriculture not farming or? is it like-
Well, agriculture this is the result of farming, but it's not the farms. So I've never heard of the word farming as an alternative asset class. All right, we gotta stop there. We'll start on commodities next time. All right, so what are y'all doing with this question? So we talked about it several classes ago, but question one on exam is essentially like 18 pages out of the notes. So it's what is the portfolio? What are the questions you ask? 3 questions, why, what, how. And you're gonna spend a lot of time on the what, all the asset classes. It's everything in the notes, but in your own words. That's why I say from this, we started, I, kind of warned you in that second week or even first week, start writing that question out as you go. So read the notes, listen to the lecture, and then as you go, write it without any notes. So you can make sure it's in your own words and you're not other people's words. But that's what this question is. I'll show you all some example answers once we get closer. But today was just a stock selection. So what is a stock? What's expected return on the stock? How do you get that number? And then the bucks, BUCS, getting through all of that. Remember, you define it, you give the subcategories, and then you talk about strategy. That's how you get through these. So it's pretty straightforward. It's a template. I want you to know it just because it's a really powerful one. All right, so we were getting into alternatives, and we finished September last time. So the next one is commodities, which is not my forte. We did some commodities at USAA, but not a lot. Commodities are generally energy, agriculture, and metals, and we're talking about the actual commodity itself. Now, how do you invest in commodities yourself? Well, now with exchange traded funds, there are oil funds, there's gold funds, there's all different types of funds. How do they do it? They don't usually buy the actual commodity. They usually use futures. So we'll talk about futures later. So they don't actually have barrels of oil sitting in some warehouse somewhere. They're using the futures market. Finviz, I've shown you that before. It's a really good place to go to see a list of all these commodities. Look at some of the history. One thing I'd encourage you to do that's really helpful, you can do it in Bloomberg in a second because they have a site in Bloomberg that'll do it for you if you get on a Bloomberg machine, but start understanding the relationship in between these. So one really good correlation to do is oil versus gold versus the US dollar. What's that correlation? What has it been over time? What's the relationship? There's definitely a relationship between oil, the dollar, and gold. A strong relationship with oil, with the dollar and gold, but even between oil. In fact, there was a few years ago where oil and gold got really out of sync to their history. You could have made a fortune if you'd bet against that dysfunction. But even here recently, it's been really interesting, oil versus natural gas. Those two have gotten really out of sync. There was a while where oil prices were soaring and natural gas was just sitting there because of what was going on in West Texas and South Texas with all the fracking. And then this year is the exact opposite. Well, natural gas has just shot up and oil's been kind of flat because of Putin. So, these relationships are interesting and you can look at them historically and then see what's out of whack right now. We thought natural gas was out of whack and then it stayed out of whack forever. It just sat there on $2, $3 and just didn't move. And then suddenly this year it jumped up above 10. So those are interesting. Agriculture can be interesting. Metals, obviously gold, platinum, silver. Those are all interesting relationships with the dollar. Gold is interesting because gold tends to just be a store of value where if you're worried about inflation, worry about the dollar, you can hold gold. We don't usually use gold in production. Maybe Tesla start doing that in their cars, but we don't generally put gold into things other than jewelry. And so gold tends to be somewhat immune to the overall economy, whereas silver is a precious metal, but it's also production metal. So it can be more sensitive to the economy. So just understanding those relationships is really, really good. Agriculture is very sensitive to weather and we saw pork prices soar. You might remember why pork prices soar a few months ago. China had I don't know if it was a mad pig disease, whatever that disease they had, where they had to destroy millions of pigs all at once. That's going to cause prices to soar, especially given how much pork they eat there. That causes a major disruption. You'll see orange juice prices shoot up if there's a major drought or hurricane or something. So these are important relationships. You can build your entire career just on one of those things because it's so specialized and you just learn it backwards and forwards. You can buy a basket of commodities. You've got to be really, really careful. So there's the S&P, GSCI, and there's the Dow Jones. But you got to be real careful. The S&P is about 60% energy. So if you buy that, it's going to be real sensitive to oil prices. Whereas the Dow Jones is only 30% energy. So they're not the same. Don't think you're going to buy one, which one, buy the one that's easy to remember because they're not the same one. Or you go in and buy the individual pieces. So there probably are ETFs that do each one of these, and you can score. That's why I say look at the relationship. You look at the relationship, say what's out of whack with the others, and why is that? Is we know oil and nat gas and food prices are all higher. Gold really hasn't done much. So why are they higher? Is it something to do with the dollars? It's something to do with Putin and Ukraine and wheat and all of that. Those are the things you can look at. There's things going in South America right now that are kind of interesting. So you look at those relationships, but it gets tough. That's why you can specialize because there's so many really, really specific factors that drive each one of these. So we didn't do much energy at USAA other than we had some hedge funds that were in energy, some global macro. It's a very specialized. And then the metals guy, the guy who ran the gold fund, he was in my department. Very, very smart guy. He retired right after I did. Very, very knowledgeable guy. He's a great presenter. I love listening to his presenters. Kind of dry wit, but he would just cling to every word because he had such an insight. So really, really smart guy. I don't know what he's doing now. I think he had like 7 daughters or something. So I think he's paying for college tuition right now in his retirement. So there's commodities. I don't know if you have questions on commodities. It's not my forte, but you could certainly find a lot of research on that. The last category, I really don't know much about, but it's just collectibles and artwork and Bitcoins especially. I've tried my best to understand Bitcoins. I'm still not sure there's anything there. Very, very specialized market. One of my students in this class, he was a coin collector. He knows I'm really, I see him on Facebook. He gets real excited about some coin he found and like, big deal, who cares? Well, it's worth $10,000. Okay, well, that's kind of nice. In Costa Rica, there's a guy who's the beetle guy. Did y'all know there's a beetle market? So he sells beetles and he was showing me a beetle. Says, yeah, I sold that for $500. He sold a beetle for $500. But why did he sell it for so much? Well, he goes out in the jungle. He gets 2 beetles that have never met. And he creates a whole new beetle that's never existed before in the history world, and he sells it for $500. And they're really cool looking beetles. I mean, they're gold and silver, and they're massive, and they have these strange looking heads and tails and all this kind of stuff. That's his thing. He was asking us for $10,000 to start a lab, and my team like, yeah, let's do it. He's so knowledgeable, but his thing was, but I'm not sharing my knowledge with anybody. I think, okay, so you die and this whole business goes down with you. His wife was the butterfly lady. She sold butterflies. You can get very specialized in here. I wish we could take my team to, I love the butterfly lady. She's got this big greenhouse and there's butterflies everywhere. You walk in and they're just all in your hair and it's kind of cool. So you can get really, really specialized. That can be your whole career. These are not very liquid markets. So if you want to sell something, it's probably going to cost you 5, 10, 20% of the value just to get it sold. So very specialized markets. I don't have new data. I got some old data. There's something called the Passion Asset Return Index. It's up 90%, but I don't know how many years that is. That's the return without it being annualized, but it just shows you some of the categories. Artwork, look at that. One's up 20, the other one's down 30. So a lot of different artwork, fine wine, stamps, coins, classic cars. You can now buy kits to build classic cars, which are obviously is current metals and this kind of things. Carpets, rare musical instruments, jewelry, watches, properties, ultra prime properties. So there's the index. I don't know that category at all. I don't know what that means. It may be kind of just historical buildings or something. But the return is a little deceptive because the cost of trading is so high. So yeah, you may have a Rembrandt that's up, 400%, but it's going to cost you, several $1,000s to sell it if you go to Christie's or whoever. And y'all watched the road show. What is it? The PBS, what's it called? I can't remember, but what is it called? Antique Roadshow. Yeah, I mean, they get all excited and they say it's $10,000. I say 10,000, that's not that much money. So they're all excited about the pass house. I can't believe it's 10,000. It's like, yeah, I mean, you're not going to retire on $10,000. And some of them, like the biggest ones, are worth $400,000 or $500,000. It's not, you're not, unless you find 20 of those, it's not going to pay for your retirement. So they're kind of nice, but yeah, there are people that this is what they do. I should call that student that does coins and just see if that's his entire profession or it's just something he does on the side. But you obviously have to have a lot of knowledge to be able to handle something like that.
How do you classify as collectible? What about secret, for example? Or even sort of art?
Yeah.
Some treat as a collectible.
I don't understand that market at all. I don't know anything about it. There's one spoof they do on Facebook where they have that like extremely expensive pair of shoes and they walk into the store and say, hey, can I exchange these, just to see the reaction? And it's kind of hilarious because I'm like, yeah, it looks like a $40 worth of shoes. And if for some reason, I don't know why it has that value, obviously they're going to limit their production and that kind of thing. But yeah, this is not my market. We didn't do any of this at USAA ever. So I don't know this market. I don't even know finance. I don't know any finance people other than that guy who does coins that this is their field. The advantage of it is that it is so specialized. But you have to be real careful because, you think about China. China was driving this market because there are so many billionaires. There's more billionaires in China's main congressional body than there are in the United States. It's pretty amazing. A communist country has all these billionaires. You kind of wonder how do you do that? But they have all this money, and so they start buying all this stuff. The prices go up, and then President Xi says, "Yeah, that doesn't really look good for us," and then the prices tumble. So you're at the mercy. One guy says, "Yeah, we need to stop this conspicuous consumption," and suddenly the prices nosedive. I don't know any unless you have some specialized. I mean, think artwork. That's a pretty evil market. With all the fakes and that kind of thing, how do you know you got something legitimate? I would never touch that market. The beetle guy, we were pretty interested in that. I had no idea there was a global market on that, and he knew what he was doing. But what I don't know is any history on what the prices of beetles do over time. That would be kind of interesting. The butterfly lady, she was just creating art. So it wasn't collectibles. She was just making art out of it. I even asked her, what could have like a butterfly as a pet? She says, yeah, it'll die after 3 months, but yeah, you can do that. So she knew her business really well, and she had the advantage that she's in the jungle and she had very specialized. So you probably have to have some trick. The guy who did coins, he had a family history of that. So you're going to have some connection, I think. I don't know if you're just going to jump in to be an art trader if you never had any background at all. I just can't imagine that unless Christie's hires you. I don't know what kind of jobs. Have y'all been out to their sites? What's the other ones? Sotheby's? I can't remember. If you went to their site, see what jobs they have for finance. I don't know what it'd be. It is a very, very, very illiquid market, very, all over the place. And now we got the, always get it wrong, NFTs. And I have no clue what that is. It makes no sense to me at all. I worry about something when someone explains something, like I saw a firm that's doing 3D printing of body parts. And I listen, I can see that. That makes sense to me. That's pretty amazing. I get really excited about that. Yeah, that is pretty good. I don't get that when people explain Bitcoin and I don't go, wow, I can see that. That's going to change the world. I'm like, you just said 3 paragraphs. And you didn't say a single word. I get worried when someone can't explain the excitement of what they're doing, when it just seems like it's circular, rational. But there may be something there. All right, then the last category we're going to have is private equity. I say venture capital and private equity. They're 2 different things. So all venture capital is private equity, but not all private equity is venture. So venture is a startup firm, very beginning, just starting up. Private equity is just a firm that's not trading on the markets. So Dell Computer went private, Burger King went private, but they were not ventures. They were well-established firms. So most of them are small companies, but there are, and then in the private equity, that's like Dell or Burger King, they're owned by one big conglomerate or owned by Michael Dell. So you're not going to get in on that. But the smaller private equity, it gives you a chance to buy small companies. And again, you avoid the daily volatility, but it's somewhat fake. You avoid it because there's no daily prices. It's not because their prices aren't moving with everybody else. So I remember my first investment job, they needed someone to do USA's private equity. And it was a really small portfolio. I think it was like 400 million when I got it. So it was USA hardly even looked at it. And the lady that was doing it, she says, I'll bring all the stuff over. And she literally brought me a shoebox with a bunch of paper in it and handed it to me. So that was USA's private equity portfolio. I think we had like 10 partnerships, really small. I put it all in Excel, just curious to look at the returns over time. And essentially, the returns were almost identical if we just put it in small cap stocks. About the same return, but the nice thing is the price never moved because the only information I got was a quarterly report from the venture capitalist, from the general partner, with their guesses of what these firms were worth, which is pretty useless information. You know, they're just doing present value, future cash flows of their forecasts. But if it traded in the market, who knows what it would be worth. And my job was to keep track of that. And then the coolest part of my job was when they went IPO, when they went public, I got the stocks and I got to sell them. So it was kind of cool my first time to get to sell stocks like that. And so I did a big study, and we weren't going to spend a lot of time on these because it was too small of a portfolio. But my job was to figure out when should we sell it? Should we sell it the day of the IPO, a week later, a month later? So I did an analysis, and for some reason I came up with 2 weeks. 2 weeks was like the ideal spot, and so we just sold them after 2 weeks. But it was interesting. And then the president of the investment company, I was talking to him about it, and his philosophy was, why are we doing these partnerships where we're investing in 50, 100 companies? If we're going to do venture capital, we're going to put $500 million in one company, and we're going to make sure it succeeds. We're not going to. He didn't see why you would diversify venture capital. If you believe in it, you get a department and you just do that, and you're really focused on that. So he didn't really believe in it. But if you do it, you're going to have an investment that's going to go a few years where you don't see anything. You give them 50 million bucks, 100 million bucks, and then they send you reports every quarter, but there's nothing there because they're just getting started. They may not even invested all the money. But then suddenly after 4 or 5, 6 years, they're going to start IPOing, and suddenly you're going to have these huge returns. And we had some pretty good companies. Medtronic, you probably heard of them. They were one of our IPOs that we had. Charles Rivers, we had them. So we had some pretty impressive firms. And then we had a bunch that just went out of business. You never heard about them. But the nice thing here is you don't have to be 100% successful. So if you have 20 companies, you could have 10, 12 of them not do well at all, but 1 or 2 of them, go up 1,000%. 50,000%, and you can make it all into one company. But you use partnerships. So there's a general partner, and then there's the passive partners that we were. The general partner is going to raise the funds and invest it. It's going to monitor it. They may even have people on the board or even have people at CFO running the firm. And their goal is get the firm up and running, give them assistance, and then get them to the IPO. And then when the IPO partnership ends, most of these partnerships are 10 years. And so it doesn't mean it's going to take you 10 years, but the expected is after 10 years, most of the firms will either be bankrupt or be IPO. That's your thought. So we had a few of these that just ran on after 10 years. You had this one, we had one in San Antonio. This is like, we had it on our books for like $300,000. And I was going, should we sell it or keep it? And the guy kept telling us there could be something there. So I said, you know what, let's just write it off to zero. And there's something there, it'll all be gravy. And we'll go for it. No one had a clue what it was worth. I don't know what to do with that, but USA finally just got rid of that. And then after I retired, they hired some people to actually do some true venture capital. And so I don't know what that team does every single day. It's not a big part of USA's business. Oh, I may not be sharing. Sorry about that. So all of that, you'll just have to, I'll have to add it later. I do want to show you something though, because one of our former students, in fact, 2 UTSA students, they're now in business together and they're doing venture capital. And I met with them a few weeks ago. And he was saying venture capital is not a good business. It rips off his customers too much. We're going to do it differently. He explained how he's going to do it. And it sounded interesting what he was saying. What I couldn't get out of what he was saying is how he was going to make it work for him. It sounded like a better deal for the investor, but I wasn't sure it worked for him. Well, let me show you what Warren Buffett thinks about private equity. There he is with his Coca-Cola. I thought he drank cherry Coke. Is that cherry Coke? Oh, it is. There was no cherry there. Okay. Y'all know who this is? Charles Ellis, isn't it? Or Munger. I mean Munger. Excuse me. Yeah, Munger. Charles Ellis is the other.
Get excited about it. So, there's, you know, there's $2 to mine and find businesses and they're going to leverage.
That's part of the issue we're seeing is, and that's why I like what the student is doing, Matthew. When you have a multi-billion-dollar fund, you can't go out and start $300,000, $400,000 businesses. It's going to take you too long. You just can't do it. And so they're kind of stuck with doing much bigger projects. And they get to the point, private equity, of just, we got to get this money deployed. And there's kind of this rush. What this guy's doing is he's doing much smaller businesses, really exciting, but much smaller businesses, very interesting, very exciting. But 50,000, 100,000, 200,000. But how is he going to actually get that work for him? That was what I was asking him. It's going to take you, it's going to be a lot of work for you. And each one of these is not going to make you much money. But yeah, you imagine you have this massive fund, you got to get it deployed. You're just like, are you going to really do the due diligence you need to do? See what you think Munger thinks about this. Yeah, so what are the returns? The returns are what the general partner tells you, which the general partner wants you to do well, so they have an incentive. Remember, they're doing discounted cash flows. If you've done discounted cash flows, we'll do it in papers 3 and 4. You can change your assumptions slightly and you get a much different number. So, you know, I think, oh, should we use a discount rate of 8% or 8.3? Wow, 8% gives us a much bigger number. We can just, you know, you've got an incentive to stretch the numbers.
So it's not something.
It gets a little cynical here, but this is absolutely true. He's talking about investment banking here. That's what investment bankers are. They're salespeople. Does he really want to be a salesperson and not an investment? No, he's being cynical here.
You can raise $10 million in the fund and you get a 1.5%. And you want to go on. choose
Jump ahead.
the institutional ones.
Yeah, he's talking about a particular institutional investor that was doing fine and they started getting into this. Why? Because there's a few large institutional like the Harvard, the Yale. They're very specialized in this area and they've done so well. And so all these others are saying, well, we got to get into these alternatives because that's how they're making these big returns. And you're getting into places they don't understand.
You're all in a different direction, they, and it's just easier.
Okay, listen to this. This is our industry. So that's the private equity side. People out there getting the money, they make money by getting the money. They want your money. They're talking to people who aren't finance people, they're officials. And they're going to them, the kind of snake oil salespeople, and they're getting the money and it makes them really happy. And he says it's not a fair fight. Let's give it this. Essentially, he says, how can you charge 2 and 20? Are you really adding them value? And he says, well, because I can't charge 3 and 30. So, and it's Jack, oh, I forget the name, Jack. Oh, I can't remember his, but the Vanguard guy, Jack Bogle. I mean, he's one that says, you know, this is a business that is more focused on marketing than on investing. And the incentives are really poorly aligned, and you know, you're better off in investing. I won't. Munger gets into it. Let me show you this last thing from Munger because I think he makes a pretty good point here. Unfortunately, this thing comes up at the end that hides his face. Sorry, I don't know why that comes up.
Also, the thing I just got is it's a very easy one. What you think?
So I don't want you cynical, but that is our industry. We do that a lot. I see that a lot. When I had salespeople come to me, Fidelity comes to me, they've got several hundred funds. Which ones are they showing me? The ones that have recently done well. Why? Because that's in my best interest? No, because that's the easiest ones for them to sell. What does statistics say? The ones that have recently done well are most likely to do what? Do more poorly going forward. Why are they showing me the ones? Because they're salespeople, they're not investors. And I'll go, well, why don't you show me these other funds? Well, they haven't done well. We were at the point like, well, let's show us ones that haven't done well, because those are the ones we're actually interested in. But if you're a committee, you think about it, I'll talk about this in my risk class. If you're a committee, your number one job, if you're running a pension plan or an endowment of some kind, your number one job isn't to make the pension plan do well. Your number one job is not to get sued. And so what are you going to do? You're going to do what everybody else is doing. You're going to do the safe thing, even though you know it's not in the best interest of the investor. So it's a really horrible industry. So think carefully when you pick this industry. I used to tell students, you know, your first job, just take it and learn. But your second or third job, that's when you start thinking about what you're going to tell your grandkids in 40 years. So, you know, start thinking about, are you adding value? Are you just selling stuff people don't need? You know, so So that's part of the downside. That is the big part of the downside of private equity. It charges enormous fees. The data is really shaky and really shady. It's really hard to know if they're adding value, but because everybody does it, they get away with it because all these massive funds, they need to invest somewhere. And everybody else is doing it. So they'll put, CalPERS or what are these massive multi-billion-dollar funds? Yeah, they're going to put $1 billion in private equity. Why? Because that's what they're supposed to do. It's a kind of a evil industry. You can work there. I mean, I'm not saying it's bad to work in the evil industry and make a lot of money over your life. And when you retire, you make something up for your grandkids. But ultimately, you're going to have to face back to what you did for 50 years of your life. It'd be nice if you could say you actually did something valuable. Private equity is important because they are starting new businesses. It's really good to do. So I'm not saying the actual investing in new business is not a wonderful thing to do. It's the people doing it and their incentives and how much they're getting paid, I think, is part of the issue here. So any questions on private equity, venture capital? Doc? Yeah. Big pension plans love alternatives. They tend to do real estate. They tend to do a lot of private equity. Yeah, definitely. Part of it's the academia saying you got to diversify. And private equity and real estate, remember, we don't have good data. So they look lower risk than they really are because we're using a lot of appraised values. And people know that, and they still use the data that shows, hey, this is a good diversifier, even though we know realistically it's not. And so some of this is just kidding ourselves. It's an industry, people have to invest. You got to invest billions of dollars. You got to put it somewhere. You feel stupid just putting it in stocks and bonds because that's too easy. So they got to earn their pay by doing something wild and crazy. And so, yeah, that's why, if I were you, I would be fighting to get into a family office because I love family offices, because family offices only do what makes sense. They don't have any clients other than this wealthy, whoever this person is. And that person says, hey, I got 5, 10, 20 years. Yeah, let's do what makes sense. And they can be really patient. They're really great places to work, but they're hard to get into. But yeah, I did the pension plan for a while, and we were able to do whatever we wanted, but that's because I had a CEO that if I told him no one else is doing that, he said, let's do it. That's not the normal answer. You can talk to John Toohey, what he tried to do, what we did at USA, he tried to do at AIG, and they said no, because no one else is doing this. And they were too scared to try it. So if you really want to do true investing, where you're investing in the best interest, you have to somebody get away from the crowds. And pension plans have a lot of pressure to do what everybody else is doing. It's kind of scary. Now, if you want to work in venture capital, private equity, there are certain cities that are really known for it. So especially like Boston. Austin's starting to get like this, but they tend to hire from MIT, UT Austin, so you almost have to go back and get a graduate degree. We have one alum up in Austin right now, and he's doing great. And I knew he would. It's just a really, really sharp student. And he's gone on to the private equity side, but he's actually working for a startup company. And so we have a few students that are doing that. So it's tough. I don't know if I know too many that are actually on the private equity side, other than the two that started their own firm. But you almost have to get a graduate degree from one of those private equity schools if you're going to do that. So
What are they doing? I know you can ask them, like, what is it for you? Did they give you any answer to what they're?
I asked him about that, but he said, we're just starting out, we're getting into it. Because he said, you just spent an hour on the phone with me to try to get a $50,000 or $100,000 investment. That's a lot of your time. Even if you charge 1%, that's not just. And if you have 50 of those calls, get one person. Yeah, so we'll see. He's just starting out, really sharp. Both of them are very sharp. So we'll see. He's trying to do it so that the incentives are all aligned. So anything he does, he's got his money in it as well, and it's somebody he believes in. So, but wow, it's hard. to do it at 300,000 at a pop. It's just, you're not gonna make much money that way. We'll see. I'll check back with him every year, see how he's doing. He's the one that sent me the Warren Buffett video. All right, what about other alternatives? I looked up alternative investments on Google just to see what the current list is, and it's essentially our list. There aren't really new things in there. The newest things I'm seeing that weren't on the list I saw, infrastructure is a big one. More and more people are doing infrastructure. So you invest in a toll road, an airport. Those can be interesting investments. We never did that. What about hedge funds? Hedge funds was on the list that I saw, but I don't consider hedge funds to be an alternative investment. We did hedge funds at USAA, but we didn't do them as alternatives. We did them as part of our equity portfolio. Or we did them part of our bond portfolio. So hedge funds are either a pure asset play. So they're equity hedge funds they're just investing in stocks, but in a very different way. Or what we call alpha plays. They're just trying to add return. So they're not really an asset class. They're just a way to beat markets. So I consider them alpha plays. One thing you can look up that should still be out there. You might look for it, but it's called alpha beta phase separation. Have y'all heard that before? The internet is so slow. It's going to take it 3 weeks to come up. Have y'all heard of that alpha beta separation? Really cool term. Have you heard of it? Yeah. It's an interesting concept. So alpha beta separation. So beta is the asset class we've been talking about. Large cap stocks, small cap stocks, US stocks. That's the beta. The alpha is you're trying to beat the market. So the theory is if you go to Fidelity and say, hey, we want a US large cap fund and we want you to beat the market. Well, their only choice is US large caps. They can over allocate Google, under allocate Apple. They can buy more Walmart or less Target. That's all they can do. Well, the alpha beta separation says, don't do that. Just go buy a really cheap US large cap fund and pay like 1 basis point, and then come to us and we'll go through the entire world to find your alpha. We might be long UK and short France. We might like Canadian bonds and not like Swiss bonds. We might like the yen and not like the pound. We get the entire world. There's no limit for us. So we can find alpha wherever they are and we'll add that. And that's what alpha separation is. So you buy an S&P 500 index fund, pay almost nothing, and then you go find a hedge fund and they become your alpha. So we did that at USAA. We bought an alpha only. I did it in a pension plan. And essentially what we're trying to do is just enhance our return by they were market neutral. By using market neutral, I gave them the entire world to invest. So yeah, it's an interesting approach. I don't know if they use that term as much anymore as they used to, but it's an interesting strategy. But again, that's not an alternative investment. It's just a way to beat the markets. So it's an alpha play. What else? Derivatives. I don't consider derivatives to be alternatives. They're just another way to get into the markets. Options are a really good way to get in the stock markets. Futures are a really good way to get in the markets. So it's just another way to invest. Currencies could be an asset class. We saw that when we were talking about bonds, non-US bonds. Something else you could look up that's really fascinating is currency overlay. These are pretty popular. So currency overlay portfolio, you go to a manager and you say, I got this global stock portfolio. And I'm in Japan, I'm in Europe, I'm in all over the world, but I'm not doing anything with currencies since I don't know currencies. So we want you to take our portfolio and then you trade currencies around that. So we might have 20% in Japan, but this is not a good time for the yen. So we'll have 20% in Japan, but you're going to actually sell yen and buy the US dollar. And so we'll have Japan stock market exposure, but without the yen exposure. But since we don't know currencies, we're going to outsource that to you, like a Barclays or something like that. That's what they do. And so you can find these people, and this is what I was talking about. These are the kind of people that are usually run by economists. That's usually some PhD in economics is the head portfolio manager, because currencies is all about central banks and inflation. So let's see if Barclays is still in this business. So Barclays is a good one to go to. So that could be your entire career, but if you did that, you would definitely go back, get a degree in econometrics, and probably have to get a PhD. And then hedge fund strategies, you probably should know, we talked about this in my risk class the other night, just know some, or last night, I think it was, know some of the major ones: long short equity, market neutral, global macro, managed futures, convertible ARB, merger ARB. There's a few that are really just, you should just know as a finance major. They're pretty easy to understand. So long short equity is just another way to buy stocks. There's nothing special about that. Market neutral is really an alpha play. The reason it's called market neutral is so you have no exposure to the stock market. If the market's up 10%, you may or may not be up. If the market's down 10%, you may or may not be up or down. It's unrelated. What it's trying to do is just beat the market, give you an extra alpha to add on top. Same thing with global macro. Global macro is just a way to add a little alpha to your portfolio by going long and short the entire world. So it's hard to think of any other alternatives out there. I didn't mention Bitcoin. I think most people would put Bitcoin under alternatives. NFTs, I don't know where you put those because I don't know what they are. It's people are talking about this stuff. It was kind of humorous a few years ago. They had a lunch here in the CFA local institution, and the guy was talking about Bitcoin. And we get there, and he couldn't answer any questions. And there was a UTSA student there, so the UTSA student stood up and started answering all the questions because he knew more about it than the guy that was presenting. That's how new it was. College students know more than the people that are supposedly doing this because it's just so new. And that poor guy, I felt sorry. The guy that was presenting, I felt sorry for him. But yeah, this is new stuff. I don't know what you'll have. We can be pretty confident there's a high chance that artificial intelligence is going to change everything, and we'll see what it does all of this, including private equity and hedge funds. So will there be a fund run in 5 years which is entirely run by the computers and there's no humans at all? We're kind of getting close to that as it is anyway. So the world's changing. I'm kind of glad it's better y'all than me, because I'm too old for all this new stuff. But it's getting kind of crazy. All right, so that's the end of the list. So what are you going to do? Exam 1, question 1, in your own words. So no copying and pasting, should write it out. So what is the portfolio and how would you help someone construct one? That's the 3 questions, and the asset classes. Well organized, I've somewhat given you the organization, so I would recommend you use that, not because I want to see my own organization, but because I want something that when you hear that question in an interview, you've got something organized in your mind to go with just immediately, and you can just start rattling it off. If you do any kind of wealth management or any kind of portfolio management, they love that question. Someone suddenly walks in with $500,000 and they want you to help them. What would you do? You go through this entire thing. It needs to be a professional rather than a student perspective. So you want to make it, you can use jargon. You want to make it sound very, very sophisticated. Needs to stand on its own. So don't write it like you're writing it for me, but that anybody were to pick up your paper, they should be able to understand the entire thing. It should be that kind of organization. And you can go on. I'll show you. I almost don't want to show you one answer from a previous semester where he really went overboard, but maybe I'll just show you how overboard you could go. I was talking to him about it because it's like, you had a lot of stuff in there that didn't help you grade any because you were kind of already hitting 100 before I even got there. He says, oh yeah, I don't care about the grade. I was doing that to teach myself and learn this stuff. So he was more focused on learning it than he was on the grade. So that's why he put all that extra stuff in there. So I'm giving you those things you can look up. There's plenty of things you can look up that are related to this because we're scratching the surface is even too far. So you can always tell if finance is the right degree. I'm trying to almost scare you a little bit that, boy, there's so much there that we're not even coming close to talking about. So your response is either, my word, there's so much, I give up. I can't handle it. Or your response is, well, I can't wait to get out there and learn one of these things in depth. And that's where I would be. That's what would excite me starting my career over, is like, wow, there's so many areas of specialization. I know I'm at least above average intelligence, and I'm going to be spending 50, 60 hours a week on this. Just think where I'm going to be in 3 years. It's going to be pretty amazing. And you can get excited about that, can't you? It's going to be some area you're going to get so much in depth on. It's just, you're going to be, no one's going to be able to talk to you again, except for your peers at work. And, when they come to the party, all your spouses are going to be like, they're not going to have a clue what you're talking about. You're all going to be over there like in a foreign language. And that's where you want to get. Your biggest stress right now is, what is that, isn't it? It's going to be in this area, this area, this area. There is some stress to that. Part of that is going to pick you. You're not going to pick it unless you're really, really precise. The second thing is I get from students that are stressed out is they want me to help them plan the next 50 years of their lives. And you're not going to do that. So you don't have to worry about that. All you got to do is do well in your classes, interview a lot. And then when you get the 4 or 5 offers, you pick the one that's the scariest. It's that straightforward. So you don't have to go out 50 years. You just need to get through the semester, interview a lot, especially in the fall. The fall, you should be interviewing, you should be applying to 20 jobs a day. Just constantly, especially if you're a junior, you definitely have to be interviewing this next fall. Extremely important. It's volume. It really is volume. And then why do you pick the scariest thing? Because finance pays more the more difficult it is. I brought the ethical issues. Do you start thinking about that at first? Well, anything you pick to specialize in, there will be an unethical and an ethical version of it. So I say just get in there and learn it, and then 3 years later, then start deciding where is the value really, and where am I not a salesperson, where am I really an investor? And so you can start learning this stuff now, start getting ideas. So it's a template that only scratches the surface, but it has the entire surface there. Everything, all the major pieces are there. So then you just got to figure out where you're going to nose dive, deep dive. You don't want to nose dive. All right, questions on that? Thomas, is it getting better? Yeah. And you can ask me more. You'll see what that exam question is. Everybody's good. What about exam question 1, exam 1, question 2? This is the tactical. There's nothing. Now the tactical will take in class the first 30 minutes, closed book. There's nothing you have to know for this that you're not going to do for question 1. It's the exact same material. It's just application. So I'm going to give you a scenario. We'll have a team case on this probably maybe like next Wednesday. We'll do one. Well, I'll give you the exam from last semester and you'll actually work it in class. All right. I'm going to give you the template. Monday, we'll go in more detail on it because I'm going to give you exactly how you want to look at it. But I give you a scenario. I'm not saying these are my scenarios. Some of them are pretty laughable now when I look back, but they're not. In fact, sometimes what I do is I just go out and steal somebody else's just so I have one. There's one year USA published theirs every year, and I just went and stole John. John wrote that one, and I just stole it and reworded it and used his just so I didn't have to come up with something new. But what kind of information I'm going to give you, and it's really amazing how little information you need. Number 1, is the economy growing or shrinking? That's pretty obvious. Recession, what are you going to do with stocks for recession? Overweight or underweight? Underweight, pretty obvious, right? What are you going to do with high quality bonds in a recession? Probably overweight. And I say in a recession, I really mean if you're expecting a recession. If you're already in a recession, it's too late. All right, so there's the first one. How's the economy doing? The second one is interest rates. Are they rising? Are they falling? Are they more volatile, less volatile? Interest rates are rising. What's that going to tell you? Going to shorten duration. Right? So rates are rising. You want to shorten duration. Rates are falling. You want to lengthen duration. But we also know in a recession, interest rates usually do what in a recession? They usually fall. So you have a little bit of double there. Would I give you a scenario where we're going in a recession and we have rising rates? Probably not. It's just too bizarre. So I try to make it pretty normal. It's getting easier now. It's getting tough. A few years ago, when interest rates were so low, it's hard for me to do a scenario rates falling because we're, at historically low rates. How much lower could you go? So, and then we have the volatility of rates. Rates, we either expect them to be more volatile or less volatile. That really only relates to convexity. Do you want to buy convexity or sell convexity? So that's the only one there. I gave you some inflation numbers. That's usually tied to the interest rates, but not always. But the only thing we have there is TIPS, the inflation protected bonds, and then maybe gold or real estate. We talked about real assets protecting you from inflation. Talk about inflation. And then after that, I have to give you very specific information. So when we get to international stocks, if I say the US is having a recession, it doesn't tell you what to do in Europe and Japan, unless I tell you what they're doing. So I'll give you, if the US is expected to do better or worse than these other countries. And I have to tell you about the US dollar. And I usually will make that consistent. So I'm not going to tell you, I expect Japan to do really well, but I also expect the dollar to be strong, because then you're like, okay, well, which do I do? If a strong dollar, I don't want to be in Japan, but so I'll usually say, I expect Europe and Japan to be weak, and I expect the US dollar to strengthen. So you're consistent on those two. And then certain things, it's going to be, you just have to remember value versus growth stocks. You remember which does better in a recession?
Value.
You would think value, but what's the right answer?
Growth.
Growth. Why is that? Remember, value stocks are low quality companies. Something's wrong with them. They have a lot of debt. They have earnings problems. Bed Bath & Beyond is a value stock. Macy's is a value stock. Do you want Macy's if we go into a recession? What is Bed Bath & Beyond going to do if we have a recession? They're already done for anyway, aren't they?
Would there be exceptions, for example, like AutoZone or something, where I assume AutoZone's more of a value stock?
Well, if you look specifically at the companies, so Meta was a value stock this last year, but they were growth a few months earlier. We're talking about the overall category. That's why I showed that article last semester from GMO, which they said the conventional view of value growth is not working right now. So, but I gave you the scenario, so you have to go with the scenario. So this isn't you telling me what you think the economy is going to do. This is what your boss believes, and then you've got to come up with a strategy based on their view. All right. Things like emerging countries, I'll just tell you how emerging countries are doing, and that's kind of a gimme. So the key with this is to know how many bullets are going to be in your answer. It's usually 18 bullets. What do I mean by that? Well, for treasuries, you're going to have 2 bullets on gold treasuries. First is quality, recession or not. Secondly is duration, are rates rising or falling. And you'll always talk those 2 things. So when you come to treasuries, you say overweight. Why? I like long treasuries because we're going into recession, so I need the quality. I like long treasuries because interest rates are falling. And you want to make it 2 bullets. If you say I like treasuries because we're going into recession and rates are falling, you say, well, that's treasuries, but they're long treasuries. What have they been short treasuries? So you got to make sure you have 2 bullets. One of them is related to the weak economy, so you want the high quality of treasuries. One of them is related to interest rates falling, so you want the long duration of the long treasuries. Everybody see that? There's 2 things there. Same thing on, so there's 2 there under inflation, under TIPS, inflation protected bonds. There's only one thing, inflation. What's it doing? So that's pretty straightforward. Although last year we had inflation and TIPS had a negative return. So who knows? But I'm going with your traditional view here. Mortgage-backed securities, the only thing there is the volatility of interest rates. So there's only one thing there. So there's 4 things so far. Munis versus corporates, there's going to be 3 things you're going to talk about there is quality, direction of interest rates, and the tax code. So those 3. We'll practice this. You don't have to get all this right now. High yield, very simple. Remember high yield, I said ignore interest rates rising or falling. We don't think about duration of high yield. The only thing we care there is the economy strong or weak. You got a strong economy, high yield is going to be like almost a stock. A weak economy, you absolutely want to avoid high yield. So quality is the only thing you have to worry about. I'm gonna give you a list of things. There's one thing that won't be on the list, and that's stocks versus bonds. You have to make sure you know to say something about that. And then within stocks, you're gonna have large cap, small cap, and this is where it gets tricky. This is where students lose most of their points. I might give you small cap growth stocks. Well, there's two things there. There's small cap and their growth. So you better have two bullets under small cap. All right. Small cap, we like them in a strong economy. Growth, do better in a weak economy, so I probably won't match those two. But I might have small cap, high beta. So it's small cap and it's high beta industries. All right. Well, if I have a strong economy, I love the small cap because the small cap do well. And in a strong economy, I like the high beta. So you see how there's two things there. You want to talk about them both. And you don't want to combine it. You don't want to say, I like small cap, high beta in a strong economy, because I don't know if you like it because it's small cap or do you like it because it's high beta? There's two things in that question, right? So you got to get that part down. So under stocks, there's about 4 things under stocks that you got to get. Is it large or small cap? Is it high beta, low beta? Is it growth or is it value? You're going to see those different combinations. On international developed markets, it's just 2 things: how their economy is doing and what's the US dollar doing. That's 2 things. And emerging, it's just 1 thing: how's the economy doing? And in alternatives, it just depends on what I give you. But you'll discover all of my exams, there's 17 to 19 things you want to say. If you get 6 of the 19, then you'll make 30% on the exam question, assuming you got all 6 of those right. And so that's why I'm real picky on this, not picky because I'm picky, but picky to help you with your score. Is, you're probably gonna have 18 bullets on your answer. You want to make sure you have those 18. You don't combine them because then I don't know if you're making a distinction. Yeah, you're gonna write one in advance, which is question 1, and then this will be handed out at the exam and you'll have 30 minutes to do. We'll get plenty of practice on this one. But you can see the kind of things that we're looking at. Surprises on the positive side: economic growth, interest rates should rise, emerging countries should see strong growth. Europe should see some weak growth, the US dollar should strengthen, some added diversification. That's where you talk about alternatives. You got your tax rate. Those are the kind of things I'm going to give you. Each scenario is going to be a little different. I have no idea what scenario I'm going to do here. It's going to be positive or negative. I'll probably have something on inflation in this scenario. So you have quality comments, you have duration issues, you have different types of markets. Those are the kinds of things we're looking at. So we'll get some practice with these. I'll give you some very specific questions on Monday, especially on Monday. We'll spend the entire time on this and give you as much practice as possible. All right, we'll stop there because I don't want to get into it.